Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This week, we see things really rounded off with the core PCE price index and US GDP readings coming out on Friday. Of course, hot off the heels of the CPI number a week ago. Certainly, this is a potential market mover. So let's look at how it can impact the likes of the dollar, the likes of gold, and for US equities in the Dow Jones Industrial Average. So first and foremost, here's the breakdown in terms of market expectations. As ever, the core PCE price index expected to come in at 0.2, once again, a replication of the figure for November. Of course, when we're looking at these numbers, it's worthwhile bearing in mind exactly what we're looking at. This is the December reading. Also, when it comes to the sort of wider picture, 2.8%, so remaining once again at that same level on a year-on-year basis. If you look here in terms of the breakdown, this is where we stand for both the headline and the core PCE price index numbers, but really it's all around the core. That is the favored metric utilized by the Federal Reserve, 2.8% essentially for both of them. And you can see the breakdown on a month-on-month basis at the bottom, where you can see essentially between the December and then particularly January and February months from last year, we saw elevated monthly inflation that hopefully when it drops out does provide the basis for disinflation for this PCE figure. Now, bear in mind that the core PCE number at 2.8% is now well above the CPI number. So there is a hope that if we see a decline in terms of the PCE number, then it provides the basis for a more dovish outlook for the Federal Reserve going forward. So if you're looking at a potential 0.2 figure for the core number, well, this time around, it's relatively similar to the figure from the previous December. However, if you look at a month forward and 2 months forward, well, you're looking at 0.4 for January, 0.6 for February, roughly so. And so you're looking at potential significant disinflation for those months in particular. Now, one thing worth noting is that, of course, we've just come off the back of the US CPI report. Here is the breakdown of all the different parts that go into it. And notably, with that 2.4 figure coming ever closer to the 2% level, it really needs to be sort of brought up, the fact that for the most part, we have distortions because of those shutdowns. You can see October and November data missing here. And so you don't necessarily have clarity over whether the data collected over that period, because for all of these metrics, apart from, as you can see here, gasoline, new vehicles and used cars and trucks, they just didn't have the data, right? So for the most part, they've essentially just passed through on the CPI and said, well, the numbers probably didn't change much, which essentially means we've got like no inflation for October and November, which is very unlikely. That's what provides the downward drag for the CPI in particular. For the PCE, the way that they've sort of measured it is a little bit different. For example, if they see the sort of year-on-year figure dropping to a certain, let's say from 2.8 to 2.6 this time around, then they're going to essentially factor in that the ones in between are somewhere in between. So they do see an increase each time around. So there is a difference in terms of how they are calculated, but nonetheless, there's certainly significant disruption. And for the BLS, there is a perception that they've potentially been fudging it to drive both PCE, but particularly the CPI lower. And that's why we've got that 2.4 figure and currently 2.8 figure for the PCE number. But certainly there is significant question marks around the validity of some of this data owing to the government shutdown that happened in the past. Now, in terms of whether the number should actually be higher, well, trueflation, which essentially takes a bunch of real world inputs and tries to create their own metric, shows that inflation should actually be at 0.87. Not too sure about that, but certainly they're pointing towards disinflation across the board, services and goods, and core actually rising a little bit more recently. But certainly as things stand, CPI heading lower, the trueflation CPI heading lower, the core PCE at the moment expected to stay relatively stable. What's the release going to mean in terms of the different markets out there? So essentially, if we're looking at the implications for potential rate cuts. That's how we're viewing this. So will this report lead people down the pathway to believing that we're going to see additional rate cuts coming into play from the Federal Reserve? Now, right now, markets are not pricing, I believe I put it on, I forgot to put it in. Markets aren't pricing a rate cut for the next two meetings, essentially under Powell. They don't think there's going to be a move. Part of that came after the latest jobs report, where we saw a better than expected 130K non-farm payrolls figure. And so people thought, well, this just isn't the environment that Powell's going to think that they need to cut. However, beyond that, of course, there's a lot of conjecture. If we see Kevin Warsh coming into play, and there are arguments that actually that could be delayed owing to the case against Jay Powell at the moment. If it were to be delayed, well, that would probably shift expectations and probably call for a longer pause. But even if they weren't delayed, there's a lot of uncertainty over what Warsh as a president would do. Would he come in on a relatively hawkish ticket? Would he essentially come forward and say what many believe, myself included, well, AI is going to drive inflation heavily lower, and therefore we can ease rates to a greater degree. Certainly, as long as we see inflation moving lower, then that actually stacks up. And so that's really the importance of this inflation data. So if we were to see additional expectation of rate cuts, we'd see a lower rate for the 2-year coming into play. And so what we're seeing here is essentially the relationship between the 30-year yield and the 2-year yield. And so essentially, the higher this goes, the additional rate cuts are priced in by markets. So it's the relationship between long-term and short-term rates, and the relationship between that and gold. If we're looking at it through the prism of the short-term end of that yield curve, which would be essentially the 2-year, because that reflects to a great degree the market expectations over exactly what the Federal Reserve is going to be doing, then essentially if we see markets pricing additional rate cuts, we'd expect that orange line to move higher. If we see a more hawkish outlook from the Federal Reserve, we would expect this yellow line to move lower. And so essentially what we've been seeing in terms of the jitters around that Warsh nomination, you can see that here, because at the top end of this chart, we've actually seen a bit of a pullback. So yields coming down in terms of the 30-year relative to the 2-year. And more recently, it's been the opposite, right? People were expecting rate cuts from the Fed, but the long-term yields, the 30-year, people didn't want to touch them with a barge pole, because they didn't want to get into a story where the US had a huge amount of debt that continues to ramp up over time. And there's an argument that that should be the case, because at the moment, we're also seeing some of the sort of Mag 7 names going out into the market, into the fixed income space. And so that's really saturating the markets, adding even more competition for the US as they try to roll over some of this huge debt that they have. Nonetheless, more recently, certainly after that Warsh announcement, we have actually seen some support for the long-term bonds, and so the yields are coming down. And meanwhile, we've seen some concern that maybe the rate cuts are going to essentially stop here, or we are going to see very few additional rate cuts. That may be the case, it may not. We'll have to see whether Warsh comes in, when he comes in, and what his outlook is. But part of people believing that we will see cuts under Warsh is the ability to continue to see inflation moving lower. So lower inflation should move this orange line higher and provide the basis for, as you can see, this relationship, higher gold prices. And you can see that they're not absolutely perfect. They don't move completely in sync. But as you can see here with these sort of triangles, I'm showing you the sort of breakouts that we've been seeing in terms of that yield curve. And then you're seeing the breakouts towards the upside for gold as well. Let's look at the relationship between the US dollar and that yield curve. And you can see, whilst we saw a bit of a breakdown coming around the sort of early part of sort of back end of 2024, coming into the first quarter of 2025, by and large, it's relatively close relationship as well. Again, we've been seeing the US dollar starting to strengthen as that yield curve tightens. And so again, if we see a weak inflation gauge coming out, that potentially weakens the story for the US dollar. But if we see a strong inflation number, something that's going to hold back expectations of increased rate cuts, well, then the US dollar comes into focus from a bullish standpoint. And finally, in terms of equities, you can see that that relationship also is beneficial. for stocks. So additional rate cuts being priced in, good news for stocks. And so whilst the Dow at the moment has been holding up relatively well, if we do start to see a rise in terms of inflation, it's the kind of thing that really could put a lid on prices in terms of the equity markets. I say the Dow, is probably going to be a starker, closer relationship for the likes of the NASDAQ, which has been weakening recently and is sort of buoyed by cheap money with the tech space. But nonetheless, I wanted to bring up the Dow because I think it's a really interesting chart at the moment. So let's just jump onto the actual charts and see where we stand. So first and foremost, here is the chart for the US dollar index. You can see regaining ground. So the lows that we've seen, that was around the Warsh news, and then we've been regaining ground. The rebound coming into play of that Warsh news, then we've seen a pullback. That looks like a potential retracement. Now we're heading higher once again. So a recovery for the US dollar, is that going to be a long-term recovery? Are we hitting the bottom? We don't know, but certainly from a long-term perspective, you can see here that we've come into this zone of sort of trendline support. We tagged it, moved a bit lower, but now starting to find strength at the moment. It's too early to say that we've bottomed out, certainly because we've got the possibility that this is a sort of ABC style retracement. But certainly at the moment, things are starting to strengthen once again, emboldened by the narrative of falling yields on the long term. But certainly as things stand, I wouldn't be surprised to see further upside. And if we do see a stronger inflation gauge, that continues to push that narrative. Gold actually doing fairly well at the moment, following a pretty dodgy sign because we started to roll over once again with this lower high and lower low. But there's some fears coming into play around Iran in particular. If we suddenly see a potential war in the Middle East, I think suddenly you start thinking that gold's really going to come back into strength once again. But certainly, we just, I do like the asset, but we just got so stretched towards the upside. Sometimes you just can't really sustain that kind of momentum. And certainly it's pulled back in a pretty dramatic manner. We're starting to see some sort of normalization coming into play now in terms of the volume and volatility. But look out towards the upside. We do need to start breaking through resistance, particularly the 50-57 level if the bulls are going to remain in charge. And certainly if we do see a weak inflation gauge on Friday, that does further push that narrative. Until we see 50-57 broken, I still think there's a chance that we could see, I say 50-57, it doesn't look like it's gone on absolutely perfectly. I'll draw it on more accurately. There we go. I tell you what, I got the magnet off. There we go. So we can get our nice line 50.46. That's the actual level. So we're around that 76.4 fib at the moment. A lot of it's going to be a geopolitical story at the moment, but keep an eye out for this around the time of the inflation release. Of course, it might look a bit different from where we are at the moment, but between 50.46 and 50.100, that's a really key zone that if we break through, then things start to look a little bit more healthy. But until that happens, there is still risk of another leg lower for gold. And certainly that release around inflation will be key for that. Finally, looking for the Dow. The Dow has actually been a great performer of late because people are really jumping towards those traditional stocks and away from some of those AI narrative plays. Because previously it was a worry about overspending of the hyperscalers. Now there's that alongside the worry about all the SaaS stocks and the like. So people just want to get into the old traditional bread and butter stocks of old. Let's get back into the railroads. So yeah, the Dow looking pretty healthy. I think if we see a weak inflation gauge, it just adds more fuel to the fire. But the Dow's relatively well protected towards the downside. If we saw a rise in terms of inflation, I don't think it'd be hit to the same extent as, say, the NASDAQ. So keep an eye out for this, particularly if we break through trendline support and you're sort of 48,485, then things look a bit more different. But at the moment, the Dow looks like it's heading up to a new high once again. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.